Welcome back. So quiet for the market. So Nifty hovering around that 5690 odd mark. It has been moving in a very tight band. Keep your eye out on all the telecom space. There is an auction underway. It's likely to go on till 7:30 p.m. and the latest communication has been, according to sources, is that 2 rounds are done, but the participation from the telcos has been on the lighter side, so pretty lackluster. But of course, we'll still await any kind of an official communication. This is what is, the news doing the rounds. Before now, let's turn our attention to the personal finance segment. Hemant Rustagi of Wiseinvest Advisors is our expert for the day. Hemant, at a time when equities haven't given a lot of return to most of the investors, if you look at it over a 4 to 5 odd period, many investors have started gravitating to FDs or bank deposits or even corporate deposits where you get an assured return of, 10, 11 odd %. But at the same time, inflation is also at these levels. So, in effect, you don't have such a high real rate of interest. So could you explain what real rate of interest means? How important is it? How should one calculate it? What factors you should keep in mind? And how can you, make more money in keeping into account real rate of interest?
Well, let me begin by saying that real rate of return is very, very significant, very important for any investor. It's actually a nominal return minus inflation, taxes, and costs. While the nominal return represents the growth rate of an investor's money, the real rate of return represents, the change in the purchasing power of an investor's money. So we can say that, it's actually the real rate of return that indicates to an investor whether his actually money is growing in value or not. Unfortunately, for most of investors in India, the focus while making an investment decision is on nominal return. And that's precisely the reason we see that a lot of investors, even today, predominantly invest in traditional options. And when we talk about traditional options, we're basically talking about, fixed deposit, company deposit, bonds, debentures. And of course, the major attraction for investor there is because they get, guaranteed return. But considering the fact that most of these investment options give very low return, and the fact that some of them are not even tax efficient, generally the real rate of return from these instruments are either negative or bare minimum. So I think it's very important for every investor to focus on 3 factors. That's inflation, taxes, and cost while making an investment decision. Inflation is crucial because it erodes the value of investment over a period of time. And I think it's always a challenge for an investor to stay ahead of inflation. One of the ways that it can be tackled is by following an asset allocation plan. And within that, while investing for the long term, significantly the money has to be invested in equities, and that's because equity as an asset class has the potential to beat inflation over a longer period of time. Yeah, of course, when you invest in equities, you have to contend with volatility which exists in the market from time to time. But thankfully, there are strategies that can help an investor in tackling this volatility, which is keep a focus on your long-term goal and also invest in a disciplined manner. Tax efficiency is very, very important for both, I think, long-term investor as well as short-term investor. For long-term investor, primarily because whenever an investor is investing for long-term, there are goals like retirement, children education, their marriage. It requires investors to actually create a large corpus. And as I mentioned earlier, equity is an asset class which has the potential to beat inflation, so primarily the focus is on equity there. And thankfully, as an asset class, is also one of the most tax-efficient options. Any capital gain arising after a sale of an asset investment after 12 months is treated as a long-term capital gain, and there is no tax on that. The dividend that comes from equity and equity-oriented balance fund is also tax-free. So I think whatever returns come from nominal return that comes from equity becomes a real rate of return. For a short-term investor, it is very important because primarily the focus is on debt and debt-oriented hybrid funds. Now, these instruments typically offer low return. That's why it's very, very important to invest in tax-efficient investment option like mutual fund, because that can make a significant difference. Cost, I believe, is I think one of the most ignored aspect of investment. Of course, it's not an issue for someone who is investing in traditional options, but anyone who is looking at investing in market-related products, cost is a very, very important factor. But that's why it's often said that rather than going for an investment or an insurance option, it's better to go for a term plan, which is much, much cheaper, and then go for options like mutual fund, which actually charge you lower costs. So I think over a period of time, it's very important for investors to be following a tax-aware investment strategy. So I think these are 3 factors that make a difference. So any investor who's looking at making an investment decision should focus on that to ensure that he gets a positive real rate of return.
Okay, so let's take a real-life case study and get some more numbers in place. We have an SMS from Hari Kishore, who's written to us from Bangalore. He says he needs 1 crore rupees after 5 years, and based on the real rate of return, he asks us whether an investment of 45,000 rupees per month is sufficient in order to achieve his goals. Now, Hemant, let me just give you some background. He's 45 years of age, Hari Kishore, and he's already invested into a couple of these mutual funds like Reliance Regular Savings Fund, Reliance Growth Fund, HDFC Top 200. So his mutual fund, allocation is pretty packed at this point. What would you advise him to do, given his background?
Well, as I mentioned earlier, I think one of the ways to get positive real rate of return is to invest in an asset class that has the potential to beat inflation. And of course, the options have to be tax efficient. But I feel that that's where I think a mutual fund definitely score over other investment options. Of course, he's been investing in mutual funds already. But the fact is that mutual funds offer a variety of funds today, not only equity funds. There are balance funds, there are debt funds. So depending on the time horizon, one can look at it, basically the kind of funds which will suit an investor. In this case, the time horizon is 5 years, and the fact that money is going to be invested every month, and if one has to earn positive real rate of return, I think the ideal option would be maybe look at equity-oriented balance fund. But of course, I would want him to have some flexibility in terms of time horizon, if need be. In that case, if I assume a return of 10 to 11%, as I mentioned earlier, equity-oriented balance fund are basically categorized as equity fund from taxation point of view. So any return that will come will be tax-free here. If I assume a return of, let's say, around 10 to 11%, with this investment of 45,000, he can create a corpus of around 35 lakhs. So I don't think with this investment he can achieve his target. But if there are two ways that he can do it, either he has to increase his investment to 1,25,000 per month, or if he can extend his time horizon to 10 years. In that case, because he's already investing in equity, and I can recommend a couple of other equity funds to him, ICICI Focus or Reliance Equity Opportunity, which he can include in the portfolio, because 10 years is a time horizon.
Don't they generally advise that, it's better to put in money in a few funds, put in a big sum of money, rather than diversify into like 10 or 15 funds that you can't keep track of? I mean, this guy has already invested quite heavily into almost 6 or 8 funds, equity funds included. So do you think he should put in more money into new funds?
No, I think the key factor is you're absolutely right that there is no point in having over diversification in the portfolio, because mutual fund by nature are diversified. What typically happens is that if the quality of fund is not good, one may have to realign the portfolio over a period of time. And I personally believe that rather than having too many funds, but it also makes sense that if you create a separate portfolio for each of the goal. And the reason for that is that if you have a combined portfolio, you lose control on how much you are able to generate for each of the goals that you have. By having a separate portfolio, you are always in control of what is that you're going to achieve as far as your each goal is concerned. Yes, it doesn't make sense to over diversify the portfolio. Maybe he can relook at some of the funds, and the funds that I'm recommending are basically some of those funds which have been performing consistently. So I think the key factor is not to always go for a large number of funds, go for funds which have been performing consistently, and I think that is the key to get the best result from equity funds.
All right, Hemant, thanks so much for all those details. Well, on that note, do we slip into a very short break, or do we have... Okay, we'll slip into a very short break for now. Still quiet for the Nifty.